So I'd like to thank everybody for joining us at one of our most important panels. This is the traditional analyst panel. Our event is geared towards investors, financiers, shareholders, presenting the global maritime community to them, and of course to the rest of the industry. So the analyst panel is always a big hit, having with us the combined wisdom of all the major analysts. So thank you to Omar, to Ben, to James, to Jorgen and Randy for being with us. And of course, thank you to Hugh for taking on the great task of moderating it. Actually, we think it's a great idea to have a ship owner moderate the analyst panel. So with that, I will turn it over to Hugh, and thank you to everybody.
Yeah. Not just a ship owner, but a private ship owner. So it means there will be less sucking up than there would be if I were maybe a publicly traded company. And on that note, I won't. I think that the people here are well known. As Nick said, they represent some of the leading houses, and actually, so maybe I'd like to start. I think with Omar, and I'm going to set this up a little bit and say that I'm going to try to avoid going through, what are your picks, what are your calls, and take a little bit of a step back. And so I think, Omar, I'm not sure how many years you've been here. It goes back to Dolman Rose days, I think. So you've really seen the history of this sector in the public markets, and I think it's a sector that went through a boom period and then a period where a lot was thrown. People saying investors didn't like it because it's opaque, it's too much self-dealing. There are a lot of sketchy practices. And I think the sector itself has cleaned itself up really well. Most of the public companies now, I think at least, are really quite well run. Management teams are very, very professional. They're financially sophisticated. They're trying to make smart decisions for the most part with capital allocation and treating their investors properly. I see that. But it's still a really challenged environment. And most of the stocks have performed poorly. It's very hard to raise capital. And there's not, with a couple of small exceptions, really enough liquidity or volume here. So with that as a happy standpoint, what do you see? What can a shipping company do as a next step? Or is it really just a matter of being a bit of a slave to the market and bumping along, waiting for better times?
It's interesting. Thanks, Hugh. Yeah, I think you're right. The sector's really traded at a across the board at a big discount, relative to historical norms, whether it's on price to NAV or price to earnings ratios. If you plug in some sort of normal steady state spot rate or charter rate, I guess taking a step back, the problem is that since the financial crisis, the shipping sector has just had a very tough time at generating positive returns. And it takes, if we look at tankers, for example, it's taken extraordinary events like the oil price crash in 2014 or Costco sanctions last year, floating storage this year. It's taken that type of event to get meaningful returns. And so, aside from that, basically tankers have had a really tough time generating a return that meets their cost of capital. And that's been the same across all different other conventional segments. So it's sort of like, just like charter rates have been low, making vessel purchases not that attractive. Equities themselves, they're not generating enough cash either to justify that NAV, so hence the discount. Now, having said all that, I think we can simply say that the large-scale overbuild that we started to see at the end of the early 2000s, that's the root cause of all this. So when we think about the next decade, obviously it's taken 10, 12 years to work through a lot of this excess supply against a bit more of a moderate demand outlook. And so there is promise. And so what should companies do? I think ultimately it's a broad question of, you stay the course, you focus on what you can control. The reason why we trade at a big discount to NAV is ultimately the lack of earnings power. And if you look at tankers, the past 11, 12 years, you've really only had 3 or 4 where you've had a positive return. Dry bulk, 0. Containers, not that much. LNG, LPG, each of those 2 or 3 years. And so it hasn't been a sector that's generated positive return. And once that starts to happen, these companies should start to get valued more appropriately.
So I think then maybe let me just throw this out as a show of hands in the panel then, because I think you hinted on something that there was a article yesterday from a different Norwegian sort of boutique bank, claiming that the next decade was shaping up really to be strong for the reasons, the sort of macro reasons you're talking about, Omar, which were that it's just taken that long to finally be rid of the overordering of kind of the early mid 2000s. Who here on the panel actually believes that, let's say, within some period, within the next year, you could be making a real long-term positive call?
What's your definition of long-term?
Well, I guess, first, you all have to have 12-month targets, but
Right.
but it feels to me like most of you are sort of relegated to trading buys and tactical buys and things, because it's been, the booms have been so short-lived. Do you think that that's the way things are going to continue for the next period, where you're really going to have to keep your clients informed daily? Jorgen, you sent out a daily chart pack, with do investors really need to see every day what happened to that day to know whether they need to sell their positions?
I think if I can jump in, I think it's a fair point. Looking at we traditionally have the 12-month price target and trying to look a bit ahead. However, I think having a more long-term view on markets and stocks from our side is reasonable, and especially as you've been talking about, considering the liquidity in the shares at the moment. So let's leave sort of forecasting the black swans and the daily swings perhaps more to the interested day traders, and rather try to make sense of where the world is moving in the medium to long term. I think that's a fair stance to have as an equity analyst. It's a cyclical business, so trying to time the cycles is what we're after, and not necessarily all the noise we get along the way. So I'm not saying that makes it much easier, but definitely I think more relevant to those investors who are looking to build a stake and be exposed over time to the industry.
Yeah, I'll answer it by saying I'm fairly confident the next 5 years will be better than the previous 5 years, right? So if you allow me to say 5 years is long term, I'm bullish.
I think that's what I'm looking for. It would be, a point where you can recommend to somebody, this asset class should be, it's never going to be a core part of a holding, but should be something you should be in, and you can add or trim, but you really want to stick in it. And maybe James, I'll go to you, because I think you're conspicuous here as representing a firm that isn't a boutique firm or a specialist firm. And I made a joke, Randy, just before I was listening to your last panel, and when you got to the obligatory consolidation question, I moved into the waiting room for this. But I was saying, the consolidation, has happened. All these analysts have asked the question, and it's really happened to the analysts. The larger firms, have I think decided this isn't a core part of what they do. So here we generally have firms focused on shipping or energy, or who have developed some kind of a franchise. James, what do you say over at Citi, or a bulge bracket firm, or to your client base about this sector?
Well, I'd also point out that I don't think it's necessarily completely unique to shipping. I think a lot of sectors are pushed together, right? And there's larger coverage teams with greater responsibility in general. But not to skip ahead in sort of like the line of reasoning, but like a lot of shipping is essentially cyclical and has these valuation trends around supply and demand. And there aren't like necessarily stocks with as tremendous of narratives everywhere, right? And if you look at like our coverage overall, there's places where there's very strong stories that are sort of company specific. And I think that seemingly attracts investors on a like relative basis about where to put the incremental dollar. And so when you look at shipping, I think when there are like very strong stories, if people do become interested, I think containers is a good example now. It's just that these stories are relatively short-lived and involved around like very short pricing cycles. If there's something longer term that you were talking about like supply aging out, that could get people more interested, definitely. But I think it's just like within our coverage, there's just such a fragmented market that not necessarily there aren't as many like great stories about specific stocks the way there are in other places within our coverage.
Got it. So if we, I know we're jumping around a little bit here, but let's think about that, a positive, positive macro stories, and it was mentioned on your panel just now, Randy, like sometimes the positive macro stories don't seem to exactly pan out. The positive story around product tankers a few years ago and the moving of refineries, and sometimes it's because of overbuilding coming in. There have been positive stories on LPG, on LNG, on different sectors that have struggled a bit. So as you look forward, James, you think containerization is still a positive sort of macro trend? Are you concerned about reshoring and a halt in the long-term trend of globalization?
No, actually, we sort of think about it more along the lines of not reshoring, but multi-shoring, and sort of trade routes becoming more complex, maybe increasing ton miles. I think that's sort of the house view on that. But in terms of, but then again, from that, it's not necessarily the like mega or the multi-year mega trend. A lot of the most volatile and significant adjustments are more short-term in nature, and that's I think where investors sort of get very excited or more interested in the space, but it's only on those like short-term catalysts, not necessarily the longer-term ones that you sort of would hope for that we see some other places. So it's almost like the sector sometimes is just a slave to the macroeconomic drivers that it comes across, and the fact that those are just short-term. But yeah, to your direct question, like when we think about it, we do see like multi-shoring, but that's like a slow and long burn, not necessarily a like fierce reset that can really drive near-term upside.
Sure. How about you, Ben? I think you've been a little bit like skeptical about some of the traditional, dry and I'd call it sort of the carbon sectors, the coal and the oil based. Do you see any like really sort of interesting trends that somebody could take and watch and invest into in the next 5 years?
Yeah, I mean, it's tough. I think you look at all of the various aspects, whether it's tankers or dry bulk or maybe even containers, as James was talking about, and there's hopefully going to be some rebound. But it's hard to really have strong conviction, at least in my view, that global trade in any of those categories is going to materially be on the rise, other than a short-term rebound. In energy-related things, there is the risk of renewables or alternative energy that eats into anything that touches carbon, and certainly that's true of coal, and we've seen that for years, and potentially it's true of oil. And containers, again, I would tend to agree with James's view of a multi-shoring, but still, unquestionably, the pace of growth is not what it is unlikely to be what it has been over the last 20 years. So it does lend itself very much to this view that it is a cyclical trading business, and there's all sorts of other potential corollaries. You can go look at tobacco or other industries where they're not really growth industries, but that doesn't mean they're never good times to buy them. There are, and if you time it well, you can do well. But I think the idea that that shipping is going to be a 10-year buy and hold is maybe not something that ever works.
Yeah.
Sure. Yeah, and I've said it before. In shipping, it is not time in the market; it's timing the market. Absolutely, it is not a buy this and 5 years later just look at your screen. You can't wait 5 years, right? It's got to be a much shorter cycle.
Sure. And do you, structurally, let's say, especially maybe, a couple of you guys there have, have significant, high net worth networks or something. Is there a structural product? I think MLPs, came and then, had some headwinds in the energy side, and there were some shipping MLP style. It mostly haven't done terribly well either. Is there some kind of a product as you guys are talking with investors or with banks, or can you see, something that actually would be appropriate and appeal for a high net worth retail or just a normal retail investor who isn't, the Seeking Alpha or Robinhood day trader?
I think
Well,
Omar is a high net worth individual.
That's right.
Maybe this question's for you.
Well, it's a good question to bring up. I haven't really thought of that, but what I would say is maybe similar to that line is I think diversification of the asset, I think, is really key. It's easier for, and I've talked about this publicly in other conferences and Capital Link as well. It's much easier for hedge funds to invest in a company when they know it's an exclusive play, whether it's on capes or VLCCs or whatnot. But as management, you're going up and down with the cycles, exposing yourself, and really losing touch as a result of that with mutual funds.
Omar, sorry to interrupt you. You're breaking. Maybe speak closer to the microphone. Sorry for that.
Apologies. Did you catch any of what I was saying?
I caught half of it.
Okay. So I was just simply saying that, there's always been exclusivity on the assets. It's always easier for hedge funds to focus on pure plays, whether they're VLs or whatnot. And as a management, when you have that type of asset, you're sort of going up and down with the cycles, and really you lose the ability to interact with mutual funds and get them as a large investor in your stock. And those mutual funds tend to focus more on management strategy, the credentials that they have, the track record, and they're not necessarily so focused on investing in an asset type. It's really about the management strategy. And so we've seen companies generating big globs of cash in certain years over the past decade or so, and they've either given it back to shareholders, paid down debt, but they've also bought the same assets that they have now. And so if they were to take that cash and diversify a bit more, you can ride out the cycles more comfortably. And I think that's probably one of the biggest things that's been missing for the sector and why it trades at a big discount is it's just too many pure play companies attracting hedge funds, not enough diversification attracting mutual funds.
Well, I want somebody to take an opposite view on that, because I bet I can't believe that's a consensus across the board.
I want to go back to your previous question, and then maybe I'll answer that. Clearly, part of our business model at Stifel is the wealth management side. It's the biggest part of our business, and I would tell you that we've done pretty well over the years finding pockets of capital for individuals who don't want the high-end risk portion of the curve, who aren't going to be day trading some of these stocks, but in companies where there is good cash flow visibility and the balance sheets aren't over levered. If you can be positioned somewhere higher in the capital structure, whether that's in a preferred instrument or a debt instrument, you can get pretty good returns because the cost of equity, the common equity, can be pretty high, and for a lot of operators. And so I think, or just creating structured instruments so that people can get an 8% yield or something like that with a preferred credit position is certainly possible. And we've not had any of those instruments break on us, fortunately, knock on wood. Yeah. But we've done dozens of them. So they, and I can tell you our client base would still buy them now in the right situation. So in my view, it's a win-win. It's a cost of capital that is better than certainly the current cost of common equity for a shipping company. So it is a source of capital, and it is a good, well-protected yielding instrument for for investors. Going back to Omar's question though, or statement about mutual funds, I'm less convinced. I think honestly, having talked to, I don't know, many mutual funds over the last however 15 years, most of them have gotten to the point where they say, I'm just not going to be at the front of the line. I'm just not going to be the smartest guy in the room on this. And if it's a trading business, I either have to be really dedicated to it or I'm out. And I think when they're out for good.
Right. So Omar, then I guess, are you sort of saying that you could see, like, if there were a management team who had some credibility and some liquidity in a particular sector, you think, some type of diversification? Like, what would you say? Is it along as far as like the C-SPAN guys, and basically trying to make the pitch to say, we were a container leasing company, but what we really are asset allocators, and trust us that we know how to allocate your capital into different asset classes at the right time? Is that what somebody has to be able to do to get the buy and hold money?
I think I don't know if you have to go that extreme where it's completely two different businesses, but it's always been taboo to have a tanker company be part of a dry bulk company, be part of an LNG company, part of LPG or containers. I don't think it hurts. The companies and the sectors aren't that huge so that when you become a quote unquote conglomerate, you sort of lose value or things just get lost in the shuffle. I feel like you can have tankers together with dry bulk and you can move up and down with the cycles a bit more smoothly, and at the same time sort of forego the fact that, okay, we're always in the spot market, the BLs are always spot, Capes are always spot, have some contract business, and really I think that's been missing, that plus diversification. That the mutual fund universe is 10 times the size of hedge funds, and so it's much stickier, and they want to invest in companies where at least the management has a proven out strategy. And I think that if people want diversification, me personally, if I'm going to buy and invest, or build a company, I don't want to have exclusivity to one asset, because I could either make a bunch of money or lose my shirt. I would rather have a bit more diversity, and I think mutual funds think that same way. So
you think that if Frontline bought in Golden Ocean, it could be more interesting than Frontline on its own? Well, I guess if you look at it company by company, it's a bit different, Hugh, because Frontline's long had this 1.5 times, 2 times NAV evaluation. So for them, they may not necessarily need to do that, but other companies who are trading at big discounts to NAV consistently, maybe the market's telling us something. Let's go ahead.
Oh, I was just going to say, I don't know if a company that trades at a big discount to NAV is because they don't have diversification, right? I can name 3 or 4 companies that have multiple sectors and multiple asset classes that trade at massive discounts to NAV. And I think if you're a mutual fund owner or a large investor, I don't think you have to find one company with 6 different subsector exposure, right? You can find 4 companies and the best in each class. So I'll go with that.
What about the different companies out there? And some of you still, cover them. Some of you have started to, I think, had to expand your coverage into other sectors, and so dropped a few of them. But again, they're quality companies whose equity market cap is $100 million, call it, and pick one that we respect a great deal, Ardmore. And they've got they're well-run, good management team. And so they've recently announced a share buyback that, on paper is about, 30% of their market cap if they were to buy it all in, which I think is, when you're at a discount, is the responsible thing to do. But what's your view? Anyone can jump in, of, for these companies, is that the path? And if so, should it just be a step to going private completely, or what is the path to be liquid and relevant while still treating investors properly and giving them their capital back when it's the best use of that capital? And I give that to anyone. Jorgen, speak up. Or
yeah, sure. I'd be happy to. So I think you're focusing in on what's important here. And as Randy said, I think an important part of being a valued shipping company these days, I think you need to have some market cap and liquidity in your stock in order to attract a premium valuation as well compared to your NAV. I think you need to be a vehicle where investors can, you don't necessarily need to buy into a finishly or an already diversified portfolio of shipping, as long as you have liquid stocks to play around with in the different sectors. I think that's just as well. But the problem here is that that's really not the case, right? You have a lot of companies with very low market caps and low liquidity, where the big mutual funds can't really, get in and out as the markets change, and they do change quite rapidly. So I'm not sure if I think you need to weigh the buyback case, because in theory, buybacks, they to a large extent reflect the cheapest vessel you sort of can buy with your capital. But on the other hand, you're sort of digging your own grave to a degree by just limiting market cap in the company and liquidity as well. And I think that's something to think about. And yeah, you need to weigh up against the advantage of having share buybacks as a tool.
Well, and Hugh, you in particular and at Ridgebury have made a point of saying that capital markets are sort of counterintuitive or react in the opposite direction of what you would expect in a period of weakness. Nobody wants to buy any equity. Well, that's probably the best time to buy ships. And so that's the advantage of being private, is that you don't have to care what your share price is. You can invest when you should invest. And I would agree with Jorgen. One of the challenges is, especially if you're a smaller company, if you reduce the size of your company, it makes it that much harder to attract incremental capital, even when things normalize. And I think one of the things that you can go back and look at over time is that once a company gets painted into this should trade at a discount to NAV box, it's really, really hard to break out of that. And conversely, you can look at somebody like Frontline, and for decades they've been trading at a premium to NAV, and it goes up and down with the market. But one of the things that's been consistent there is a lot of liquidity in that stock, and so it's a much harder problem to fix, unfortunately, for a lot of these people than it is to create.
All right, let's jump back into macro. As I said, I think there have been I just heard the panel that Randy was hosting, and I think the consensus there is going through a tough period of unprecedented demand destruction this year, and we will see a normalization and that'll come back, and there's some debate as to exactly when we get back to 2019 levels of oil demand, which flows through, I think, also matches economic activity in certain areas. And there's debate around that timing. Long overshadowing that all is the long-term discussion around peak demand for oil. How do you? I mean, Randy, you sit there in Houston, and so I think that's actually probably a valuable. You probably have more people still making the case for oil than there might be up in Norway, for example, even though Norway also depends on oil, but they don't like to acknowledge that. How do you see that playing out? And do you think that as an industry, when we've had trouble always with overbuilding in a gradually growing market, how the industry can adjust into a shrinking market?
Yeah, that's a good question. We've seen BP come out and possibly say that peak oil was last year. We've seen the IEA yesterday say that 4Q21 demand's still going to be below 4Q19 demand. So it probably is, I don't know if it's shrinking from 2019 levels, and that's going to be the high. That's going to be the peak. I don't agree with that, but it's certainly going to be a slow grind higher, and then a gradual decline. right? And what year is peak? Is it 25? Is it 30? I don't know. That said, yes, I think the bigger picture in terms of tankers, at least, isn't necessarily the volumes, which obviously that drives a lot of the ships and the rates, but also the ton mile demand, right? So where are those barrels being sourced? Where are those barrels being used and refined, and then shipped from there to an end user? So even in a kind of global demand or even production, however you want to look at it, of 100 million barrels a day, maybe we don't get there again. Maybe we do, and we peak at 102, 105, whatever the number you want to say. You don't necessarily have to have just volumes go straight up and to the right to see an increase in the ton mile demand, which is the bigger driver for the tanker sector. But that said, yeah, you're certainly seeing a bigger push into LNG and other bridge fuels. And we are more long-term structurally bullish on LNG than coal, obviously, or even crude oil for that matter. But in the near term, and again, I use near term 5 years, right? You can still be pretty bullish on tanker ton mile demand, regardless of if you think that global crude demand is going to get to 105 million barrels or not.
Now, has any of you guys significantly changed your LNG thesis in the past, call it sort of 6 months, not just short term or secular, but a little bit longer term? Because as an outside observer, it feels like it's lost a little bit of its place as a core fuel as the world seems to start to look at these much more aggressive goals around 2050, and the fact that it seems, at least to me, there's been just this explosion in interest around green hydrogen and other things. And is LNG in your view, does it still have the same sort of growth profile and use profile? Again, I'll just throw it to any of you who. It's the question, I guess. First of all, has any of you really changed your view around LNG?
Well, I can respond to that, Hugh. Definitely, it is interesting the past 12 months how LNG has come a real long way, how it was part of the energy transition, and now it's been lumped in with oil. And it's interesting to see that. I think a lot of people saw that coming, but it wasn't yet happening in practice. What we have seen over the past, say, 9 months, really since maybe the beginning of this year, is the decoupling of LNG and oil prices. And so for the longest time, LNG prices were really mirroring that of oil. But for the past, really since January, February, they moved in different directions. So now the BTU intensity price adjustment for LNG is much lower than where oil is. And so it has impacted a lot of long-term projects. There's still a lot of projects in the Gulf Coast here over the next couple of years that don't seem impacted. Qatar still has a lot of projects in the medium term that look set to move forward. But beyond that, it is a question because it's that decoupling from oil has really impacted the sector. So we've dialed back our growth forecast than what we had before. But the near term, or using Randy's long-term horizon of 5 years, it looks pretty promising still.
I'll say, I think from my view, if anything, I'm more encouraged for the next 10 years, honestly. If you look at Europe, for instance, in September, European gas consumption was up 3% year over year. Electricity demand was down like 3%. So the gaining of market share by natural gas is happening despite the pandemic. I do think that it is becoming maybe LNG as a bridge fuel was not part of the conversation 6 months or a year ago, and now I think increasingly there are people saying, okay, well, it's a bridging fuel to a hydrogen economy or something else. And so I think from that perspective, and I even tend to agree a little bit, and frankly, I can see at least 6 months ago I would have said, well, LNG is going to be the ship fuel, the bunker fuel of the future. Right now I'm not so sure. And so I think it's changing for me, my view is changing on the periphery and maybe applications. But if anything, honestly, the absolute level of consumption, I think could exceed what I was thinking prior.
I'd also just add to that really quickly that LNG still I don't have the exact number, but I think it represents maybe 9% of actual natural gas consumption. And so there's still a lot of that build it and you will come type of action in that space.
Yeah. Yeah, I mean, I think, and Jorgen, what's your view out of Norway? And you guys have a lot of you've raised a lot of capital over there for speculative LNG projects. For there's been sort of a lot of enthusiasm for some of the different technologies, and people have actually been able to raise high net worth money there. Do you see things changing with the way investors view it?
Yeah, my perception is that the view on LNG has gone maybe a bit more away from the transition path that I think a lot of investors on our end were talking about before the crisis. But I just like to highlight, it's easy to be skeptical to fossil fuels in a world where demand is as it is right now at half mast and there's surplus capacity of energy everywhere. I think it's easy to get a bit run a bit ahead of yourself. I think the fact of the matter is that there are a lot of people in this world who perhaps not are willing to, be put back in living standards in order to achieve such a rapid change that perhaps is something that's viewed more from, at least from Scandinavia. I think everyone has this view that this needs to happen very fast. I don't think that view necessarily is the same if you go into the different Asian economies. So I think there needs to be some middle ground and transition first before you have the capacity to make a complete transition to something that's completely renewable. Yeah, I'd agree that the pecking order still kind of is coal, oil, and then gas. So I continue to be quite bullish actually on LNG, having had a good look at that during this summer.
Yeah. I just moving beyond that and really to the future. I think we all sometimes get a little bit tired of just counting order books and day rates and the commodity end. And sometimes something a bit exciting comes along. I remember about a year ago, an analyst was talking to me, and he had just met the team at New Fortress Energy and thought they were doing all sorts of really exciting things and was really jazzed up about them. And their stock price seems to have done very, very well, even as they've reinvented themselves a little bit. Do any of you have anything you can think of like that, something that really fits in with our sector that is maybe something still a little bit undiscovered, a little bit, what might come next, even if it's perhaps not something you could cover or your firm could really raise the money for, but you've seen the team or the pitch or things. Is there something that kind of excites any of you that you just like to see make it?
Well, I've got one. So it was last week we did a conference call with Alexander Severies from CMB, who they're doing hydrogen and but more specifically, and as it relates to shipping, they're talking about green ammonia as a bunker fuel, which is an interesting idea. I think it has some ground to cover to get down to being economic, but I think at the moment, if you put green in front of the word energy, you go from being unpopular to the most popular person in the room. And I think there are a lot that, especially as it relates to hydrogen, there is many billions of dollars being thrown at ideas. Some of those are going to work. Most of them probably won't work, or at least work well enough. But if somebody can economically make green ammonia work and produce it in Namibia or Morocco or Chile or someplace, and refleet the global shipping business with zero carbon, hey, I think that's tremendously exciting.
Separate yet related. What's going on with Scorpio bulkers with the transition away or transition into the wind turbine installation? That's an exciting path that they've undertaken here. That over the next 3 years, they'll become an owner of one of the world's best and most powerful wind turbine vessels. So they're at a unique point where they're taking their dry bulk vessels. They trade at a big discount to NAV. They're monetizing them, taking the cash and using that as the down payment for this ship. So it'll be interesting to see how the company develops here over the coming couple of years.
Yeah, it will be interesting to see. It will be. Great. Well, I see Nick popping up here.
Guys, yeah.
Do we need to wrap it up, Nicholas, or 5 more minutes? Or?
I'm afraid that we are at the limit now. If you want to take a minute, that would be fine. But
sorry, I missed the chat box that that came. But I always love a conversation where you start to forget that you're, of course you can't see the audience, that you're an audience and you're just talking with some people whose opinions you like to hear. So guys, I appreciate it a lot. I think you threw in some things for people to think about, and I do hope if we get back together a year from now, we're maybe at that point where when I ask you, can you jump in with both feet on a 5-year call, that you're all pounding the table.
Sure. Thank you, Hugh.
Thank you to everybody for a
Thanks.
great panel. Really, this has been tremendous. Thank you very much.
Thanks, guys.
Thank you.